Good afternoon and welcome to this ACT webinar on the impact of regulation on European debt markets. This is the start of a new series of ACT webinars under the heading Navigating Regulatory Change. I'm Martin O'Donovan, Deputy Policy and Technical Director here at the ACT, and I'm delighted to welcome our three speakers. First, we'll have two speakers from HSBC, and indeed HSBC is sponsoring this webinar, so we'd like to thank them for their assistance in making all this possible. From HSBC, we have Dr. Mark Penny, who is Head of Capital Management for Global Markets, responsible for managing all aspects of prudential regulatory change and capital optimization. Also from HSBC, Dominic Kerr, European Head of Corporate Debt Capital Markets. They'll be followed by Pedro Madeira, Assistant Treasurer at Heathrow. There, some of his core responsibilities include risk management for the group, with particular focus on the impacts of financial regulation. He also leads Heathrow's debt capital market solutions in the non-plain vanilla category. So after that, we'll then take your questions, which the four of us will try to deal with. You can send in questions at any stage. If you look at the bottom of your media player window, you'll find a button there, and you don't need to wait to the end of the session. There's another button there to ask for any live event technical support. I should add that a recording of this webinar will be available on the ACT website in 2 days' time. So there will be a recording, and we'll provide a separate copy of the slides there too. I'm sure it won't have escaped the notice of everyone on this webinar that there's been a vast amount of new financial regulation in recent years, and a fair raft of it is still in progress that's going to be impacting us shortly. And companies have the impression that banks have been using regulation as an excuse for any price increase or lack of availability of service. So the impact of regulation is surely going to be significant, not only when it comes in, but ahead of time as banks adjust their behaviour in anticipation. So let's now look at the impact of bank regulation and how this will be driving the lending appetite of the banks. That will lead us on to the alternatives of using the capital market for funding, and we'll hear about the volume of usage that's coming through there, and what conditions are like and what possibilities are. Mark and Dominic from HSBC will start us off.
Thank you, Martin. Regulations both in train and in the wings could, and some would say should, have a material impact on the costs and availability of funding to European corporates. This will be a long-term trend across the industry and across Europe. It's important to recognise that the experience of every bank and corporate will be different. Banks each start from very different positions and will face different pressures. So now's a good time for corporate treasurers to dig into understanding their banking relationships and how these could affect their own supply of finance. Over the last 25 years since the establishment of the Basel framework, there have been some material changes in the components of the cost of money. At the moment, risk-free rates such as the policy rates set by the Bank of England and the European Central Bank are at an all-time low. But this benefit is masking a number of costs which are growing in the system, and which I believe will become increasingly apparent over the next few years. I'd like to pick out just a selection of these today: capital, leverage, liquidity and funding, and structure. And there will be others, and I think we might pick up on some of those a little bit later. Please don't be put off by the complexity of the slide. It's to keep your minds focused as I speak about capital. We have the new capital requirements regulation in Europe, which implements Basel III, and this will substantially increase the capital requirements for banks, with higher risk weightings and regulatory floors being applied to some assets, perhaps preventing banks applying more tailored weights to reflect the particular riskiness of their customers. Certain elements such as deferred tax assets are being excluded from the calculation of capital, and the overall minimum ratios are being increased. The picture here shows a variety of different elements making up this demand for banks. All of this is due to be introduced in January 19, in theory giving the industry and its customers time to adapt to changes. The reality is materially different and varies across Europe. On November the 29th this year, the PRA in the UK said it will expect the major UK banks and building societies to meet a 7% Common Equity Tier 1 capital ratio and a 3% Tier 1 leverage ratio after taking into account adjustments to the risk-weighted assets and CET1 capital deemed necessary by the PRA from the 1st of January 2014. This represents a 5-year acceleration in the capital process from the official timetable, and it flags further tweaking to the risk computations for assets. Major Eurozone banks will also be affected by the forthcoming asset quality review and the stress tests, which will take place at the same time. This is driven by the move within the Eurozone to a single supervisory model. Eurozone banks will need to pass a threshold Common Equity Tier 1 ratio of 8%. So, the original capital framework set by Basel and the timetable for its implementation are each being superseded by events. This matters to corporates because capital needs to be paid for, and it seems fair that the cost is borne, at least in part, by the customers using it. Equity capital is the most expensive form of money a bank can raise because it's the first to take losses when they arise. Some might argue, and this is the famous Modigliani and Miller theorem, that as banks become safer, the cost of equity and other funding should come down. But the relationship is not perfect. Taxes play a part. But the new rules still require an increase in this most expensive part of the balance sheet. The impact of the new capital regime could also be exacerbated by the outcome of ongoing deliberations by Basel on the leverage ratio. The ratio is intended to set the amount of capital which banks need to allocate against their actual or potential financing without any adjustment for credit risk. If the leverage ratio is too low, either more capital is needed or asset reductions are needed, or both. In theory, it should be simple to calculate the ratio, divide capital by, say, total assets. But in practice, there's a lot of discussion about how each side of the ratio is actually measured. Some of the discussion's political. Should you really need to hold capital against balances at the central bank? Other parts are technical. Should any collateral offset be allowed on derivative positions? And others are more judgmental. Should all the facilities be treated as fully drawn? And these make a huge difference. We expect to see and perhaps hear more in the next couple of days and see the outcome fully in the new year. But until then, we have continued uncertainty. Moving to liquidity and funding, at the same time, banks are being asked to hold more liquid assets, which can be turned into cash quickly and easily against possible short-term requests from customers for access to their funds. I've shown one view of the detailed requirements here. You can see there's quite a lot of detail. Again, liquidity requirements have an impact on the cost of money, and as these liquid assets don't generally make a good return, it's particularly accentuated. Effectively, when banks suffer a negative real rate between their cost of borrowing and what they earn, this then needs to be reflected in the cost of borrowing, or in fact the income to savers as well. We've had some adjustments to these liquidity rules over the last few months, and central banks are trying to mitigate them too by allowing a wider range of assets to be permitted, some of which earn better returns. And potentially central bank facilities will be allowed to be included in the ultimate calculations. But even so, liquidity remains an additional cost which will need to be recognised in the overall cost to customers. Banks are also being asked to improve their mix of funding arrangements, putting greater emphasis on deposit funding and longer-term debt. Both of these cost money, and that price will also be passed on to customers in the long term. In the UK, we also have some peculiar issues affecting us. From 2019, we'll be operating with retail banks, which are ring-fenced from their wholesale counterparts. We must hope this will have only limited effect on corporates, but there is a real risk that deposits are concentrated in one part of the bank, probably the ring-fenced bank, while the corporates will want to hold their relationship with the wholesale banks which can offer a wider product set. If that is the case, we run the risk of further distortion in the funding market. So to consequences, as I said at the beginning, the effect of these changes will vary between banks, and they will each make different deals with their corporate customers. But overall, I believe we're likely to see an increase in costs for corporates. In some cases, where banks have to achieve higher capital ratios and they will want to avoid raising new money, we'll see a contraction in supply. Most likely, this will be in the marginal activities of any bank, countries or businesses where they have a small market share, and they may well be abandoned. At some point, it will also become clear that it's no longer efficient for banks to raise and offer expensive funding to companies. The option of going direct to the capital markets will become more attractive. And in some respects, that's one of the objectives of the European regulatory regime. And there's a real emphasis on rebalancing the provision of finance away from banks towards the markets. And we can now highlight how debt capital markets might evolve to help companies. I'll pass over to my colleague, Dominic.
Thank you, Mark. There's no question that the process of European corporate borrowers seeking to diversify their funding away from traditional bank sources has been underway for some years now. If we just look at the UK in isolation, a recent S&P report stated that while net bank lending to the UK corporate sector has fallen by 20% over the past 5 years, bond and private placement issuance has risen by 48% over the same period, encouraged by a cheaper rate environment and the success of deals and encouraging more to come. And this is in the UK market, where a very concerted programme of government-sponsored support, including funding for lending and lending targets for the state-owned banks, has bolstered banks' ability to lend and encouraged them to do so, in many cases at attractive levels in recent years. The situation in many continental European countries, where many banks remain relatively less well capitalised and less able to lend, has seen this trend magnified and accelerated. In its quarterly review dated December 2013, the Bank for International Settlements confirms this trend in the Eurozone with the statistic that more than 50% of cumulative funding by Euro area corporates since early 2011 has been met by the bond rather than the syndicated loan market. Now, this shift away from pure dependency on bank markets for debt financing by European corporates has been evident across a wide range of corporates by scale and credit rating, or lack thereof. At the upper end of the scale, we can look at two of the historically biggest unrated blue chips in the European corporate space, namely Heineken and AP Moller Maersk. Historically, steadfastly unrated, they both elected to get formal credit ratings in the past 2 years. This was in the context of acquisition activity and significant organic growth and capex, which necessitated increased debt capacity, but also because of the awareness that the changing regulatory landscape might impact on bank capacity just when they needed it most. Both of these corporates had issued unrated bonds successfully in the past, but obtaining formal credit ratings has made a very material difference to the credit spreads they can achieve and also to their market access. Formal credit ratings bringing the Yankee bond market within range for the first time. At the other end of the spectrum, 2013 has seen a record volume of rated high-yield issuance in Europe, as well as a significant volume of unrated bond issuance by corporates. The majority of this unrated issuance coming from corporates with low implied investment grade or even crossover-type ratings. Taking the high-yield market for European corporate borrowers first, because in volume terms, this has been the real story in the European bond markets in 2013. The bare statistics show that high-yield issuance from European corporates stands at approximately $110 billion for 2013 year-to-date, compared with $74 billion for the full year 2012, itself a record year. So already this represents a volume increase of almost 50% over 2012's full year total. Analysing 2013 year-to-date high-yield issuance in more detail, around 75% of it was used for general refinancing, not just of maturing bonds, but also of loans and other corporate purposes, and around 25% to fund acquisitions or dividend payments. 64% of 2013's issuance has come from repeat borrowers, 36% from first-time borrowers. Notable within the latter category is issuance from European peripheral geographies. In terms of the total pie of high-yield corporate issuance from European corporates, around 30% has come from these peripheral geographies, Italy leading the way with 11%, followed by Greece, Portugal, Ireland and Spain, each accounting for 3 to 4% of the market supply. So there's a clear trend here for the high-yield bond market to take up some of the slack from the bank segment in these peripheral geographies. Given the overall volume increases discussed, there's also no doubt this trend is also as evident in the non-peripheral geographies. The UK has been a smaller contributor to high-yield volumes in relative terms in 2013 compared to 2010 or 2011, and Germany a relatively bigger contributor, including notably several Mittelstand companies. For SMEs of a certain size, the high-yield bond market can certainly be part of the funding toolkit. Turning to unrated bond issuance, for which 2013 has also been a strong year, this is still typically the domain of household names, depending on a domestic euro bid. so French names sold mainly to French investors, Scandinavian names with a dominant domestic take-up, and so on. Often crossover in terms of credit quality and sub-benchmark in terms of size, investors familiar with these names have not been deterred by these features, and borrowers have achieved longer tenors and lighter covenant packages than they would in the traditional bank market. Little wonder that for those who can access it, this niche market is very attractive. After bumpy years in 2012, it's interesting that both the Schuldschein and the US private placement markets have actually seen reduced issuance volumes from European corporate issuers in 2013. This has been in no way investor-driven. Investors in these markets remain very liquid and ready to lend. In 2013, the Schuldschein market in particular has continued to internationalise, both in terms of investors and borrowers, providing another funding outlet for unrated corporates, including SMEs. Both of these private placement markets continue to be overwhelmingly implied investment-grade markets, which typically mirror bank covenant packages, perhaps one reason why the covenant-light investment-grade and unrated bond markets appear more attractive to some borrowers. The continued failure to develop an organised, transparent and regulated UK or European private placement market akin to the US private placement market remains lamented by many market participants. S&P's contribution in this area this year has been to establish its schemata for mid-market evaluations, new rating criteria for mid-market corporates. While there's been more activity than previously in these markets, a number of factors continue to deter the emergence of such a market in Europe. These include regulatory limitations on the volume of unlisted instruments held by insurance companies and others, while no such limits exist in the US, a very strong investor preference for secondary market liquidity, and reluctance on the part of investors to invest the necessary human capital in establishing this business. We've seen many initiatives come and go in recent years to try and kick-start this market. With necessity being the mother of invention, it's possible that it's regulatory pressures which will ultimately drive progress in this area in the years to come. There isn't time in this short presentation for a detailed discussion of the retail bond market, which has continued to see progress in 2013. While this is a long way from having what I would term serious momentum at the moment, for some European corporates it has provided an excellent outlet, typically covenant-like terms, longer tenors than available in the bank market, bullet maturities, and of course investor diversification. So 2013 has already been a very voluminous and varied year in the European corporate bond markets, with increased volumes of investment-grade, high-yield, hybrid and retail bonds from corporates, all replacing the shrinking volume of issuance from financial institutions and mopping up investor liquidity. And clearly this hasn't all been driven by regulatory concerns. Underlying government bond yields have remained low, not as low as 2012 perhaps, but low by any historical standards. Default rates in the high-yield bond market have certainly been low. Global default rates in high yield are currently around 2.8%, well below the long-term average of 4%, and they're forecast to remain low. Bank appetite to lend may be driven by pure credit appetite and overall strategy as much as by regulatory issues. Of course, there is overlap. So in brief conclusion, the debt markets are evolving, not just in response to and anticipation of regulation, but in response to wider banking sector evolution, of course the rate environment. Now inevitably some corporates will be reluctant to abandon flexible, cheap bank finance as the mainstay of their funding until they have to. Happily, the corporate bond markets have never been so varied, nor offered European corporates such a wide range of opportunities. We believe the European high-yield bond market is here to stay, and that this and the various private placement and other markets do provide feasible long-term funding alternatives for SMEs. Bank funding may not go away as the likely mainstay of SME funding, but for regulatory and other reasons, many SMEs will likely be forced to think more progressively and creatively around funding than ever before in the years to come. And this is a journey of exploration that's better started sooner than later.
Great. Thank you, Mark and Dominic. So it seems very clear that regulation is driving the capital markets to become more and more important. Now let's turn to Pedro Madeira, Assistant Treasurer from Heathrow, because I know they're big users of the debt markets. Pedro, how's all this affecting you?
Thank you, Martin. I'll now give a brief overview of how regulation has impacted Heathrow. Heathrow is a regulated business, is also structured as a whole business securitization. This is a structure which is common to other regulated industries, because coupled with the stability of the regulated cash flows allows us to hold a very large amount of leverage. Currently, Heathrow has about 12.8 billion of gross debt. Actually, most of it is under capital markets form, 9.5 billion under our main medium-term note program, whilst others is on a more high-yield type. The payback of having a securitization is that we are actually quite restricted in terms of what we can give additionally. And that's of particular relevance in both funding and hedging. Again, on the funding side, we cannot give things which are typical in the US private placement market, so we have a lot of restrictions in what we can put on the note purchase agreement over and above what we already give. And if we try to fund directly in sterling, we face issues like not being able to give a swap breakage or additional covenants. It also conflicts with the regulation in the sense that we have very strict hedging arrangements. Among other things, our banks are forced to enter one-way CSAs with us, and we on our side cannot collateralize or centrally clear any derivatives. Now, if we go specifically for some of the regulatory developments and how they impact us, I think if we go first to Basel III and CRD4, and to an extent Basel II as well. Now, this is one of the regulatory changes of regulatory evolutions that has mostly impact our funding strategy. Because we are so capital markets heavy, we are reasonably big, we do saturate the sterling market to an extent, so it's of interest to us to try to issue outside sterling. But the combination of Basel III, Basel II, and the European Commission implementation structure has meant that hedging has become prohibitively expensive for banks, particularly if we go to very long cross-currency hedging. So we are still pushed back to sterling. We cannot arbitrage efficiently between sterling and other currencies. We always pay a premium to issue in non-sterling. As a result, we end up being heavier in sterling than we would like. We are the fourth largest corporate issuer in sterling bonds. And we end up paying a premium every time we try to diversify away, and we end up paying a premium on sterling because of saturation with our investors. Of recent, this has actually pushed us into try to seek more alternative, less standard ways of funding. So we have been looking at private placements intensively, particularly private placements in which the investor holds the swap rather than us, in which investor, although they are not funding us in sterling, they might fund us originally in dollars or in euros, they actually hold a hedging for that, and so we receive straight sterling. We have had a modest success in Europe. We also have had some success in some alternative structures which allow us to go longer than 10 years. If we go then to another bit of regulation which actually has made a lot of noise but hasn't impacted us quite as much, so if we go to EMIR and Dodd-Frank, that concerned us a lot because although many corporates are unwilling to clear or collateralize swaps, in our case it's a bit worse. We cannot clear, we cannot collateralize, so we would be actually forced to not hedge. Fortunately, as EMIR has evolved, we became clear that we are an FC minus, so regulatory proposals do not affect us as a securitization. So that's not to say it doesn't have a cost, as all the regulation, the admin burden on us and on banks, which we end up paying for as well, is bigger, so it does make hedging more expensive, as most regulation seems to do. But is no longer a threat. Dodd-Frank is slightly different. Again, it's not clear to us whether we would get an end-user exemption. As the consequences of not entering into swaps and then being clear that not getting it would be dramatic, we actually currently not enter any hedges with US-based banks, which does have some impact on the diversification of our hedging. Again, it's not terrible because even US banks have a lot of UK subsidiaries which they can still issue from, although at a higher cost. But if that was to be repeated across other geographical locations, that could have a bigger impact on us. Now, I'll just highlight on another bit of regulation. This is actually something that affects UK banks. So it's the Independent Commission on Banking ring-fencing proposals. That they are actually quite a threat to regulated corporates / securitizations, but I think widely to all the corporates who use complex derivatives. In our case, we do use relatively complex derivatives, or we wouldn't call them complex, but it seems that the Commission does, which are inflation-linked swaps. They are the majority of our swap portfolio. And for us, the ring-fenced bank is clearly not going to be allowed to enter any of these trades. As a result, we are pushed to non-UK banks, or will be if the proposals come through as forecast. Because being a securitization is now also quite clear to us that the ring-fenced bank will be the one with a higher rating because it benefits from perceived government support. The non-ring-fenced bank, despite possibly being less risky, will have a much lower rating. And in fact, even our securitization restrictions, it might be so low that we cannot enter derivatives with them at all. So we will not be able to enter derivatives, complex derivatives with UK banks. This does have consequences. It does limit the market. Again, UK banks generally have the cheapest sterling funding costs. For sterling-heavy derivatives, they offer quite often the best pricing. So we will have increased pricing. Also, for some banks, this is part of the ancillary equation. So if they cannot make profitable business with us, they may be less inclined to provide some facilities we still need, even being heavy capital markets funded. And we think that banks would always be the first source of supply for things like revolvers, capex facilities, working capital facilities. So this is a brief overview on the impact of us, which is perhaps less dramatic than on others, being a more capital markets heavy issuer. We, as part of the endless quest for alternative source of funding, we do keep looking at things like retail bonds, private placements, looking at any development of a more stable private placement market in the Eurozone or in the UK. We have seen some emergence of some boutique firms which sees the fact that the market is a bit disjointing to operate as dating services, seeking to unite possible private placement investors to corporates. So we have had a few contacting us in the past. And that might indicate that there's actually quite a lot of investor appetite, but for some reason that's actually not coalescing into forming a regulated market, so to say. And I'll just now return you back to Martin, as I'm conscious I'm overrunning slightly.
No, not at all. That's very helpful. Thank you very much, Pedro. We'll now turn to questions that you've been sending in. Can I remind you, the button down at the bottom, if you wish to send a question into our panel. So let's get started on questions. Let me just, we've got one here. Floating rate bonds, not particularly specifically mentioned, I think, during the session here, but the question is, floating rate bonds from non-financials are rare, but apparently this is changing. Will FRNs become the new norm?
Thanks, Martin. I'll take that. Yeah. You're absolutely correct that the volume of corporate FRNs being issued is on the up in 2013. Historically, from an investor perspective, of course, we think about FRNs as a defensive product, a hedge against rate rises. I don't really think that's what's going on here. I mean, nobody believes the Fed funds rate is going anywhere before 2015. Of course, we've seen the ECB cut rates by 0.25% on November the 7th. I think this is much more about, for investors, about diversification, about a place to park money almost without taking a view for the short term at least. And most of these floating rate notes are very short term. I know that Mondelez, the spin-off from Kraft, issued a €400 million 18-month FRN fairly recently. And in fact, in the first half of this year, the percentage of corporate FRNs in euro as a percentage of the whole market was up from the single digits we've seen in recent years to being about 15% of the market. That's actually the run rate in US dollars as well, around about 15%. And in the US, we saw in the summer, after Bernanke's comments initially gave concerns that tapering was coming, FRN shot up as a percentage of the market, something like 20% in July, having been only 7% in June, and it's again settled around 15% of the market. So it's come back. I really don't think it's necessary. I mean, of course, it sits there. It is a hedge against rates rising, but as they're such short-dated products in the main, I don't think that's really what it's about. And I think about somebody like Shell, who issued 1.75 billion of 2- and 3-year FRNs in November in the dollar market. I think that's perfect for what certain investors want for a certain segment of their funds. Very safe credit and a short-dated defensive instrument.
Right.
Can I just ask a question to Dominic? Dominic, do you think we'll ever see longer-dated FRNs in the UK market, which is something that might be of interest for us?
Honestly, not much longer dated than 5 years. I absolutely see why corporates would like that optionality, but for the same reason, I don't think investors would as much. So, long-dated natural FRN market, I don't see. I mean, I know there's been a lot of talk about the increasing cost of taking swaps on boards for corporates and increasing bank pricing, but I think that's been much more a factor probably for the cross-currency market than the interest rate market. So, I think in terms of corporates having the ability to swap longer-dated fixed-rate bonds, I think that will continue. I don't, to be honest, see tremendous demand from investors for longer-dated than 5 years corporate FRNs.
Actually, can I just follow on from that? Pedro, I mean, in terms of the floating-rate, fixed-rate mix, I mean, is now the time to be fixing rates? Your business is presumably quite heavily orientated towards fixed.
Well, we have strict covenants who force us to be around 75% fixed. And wherever possible, we do try. We prefer to manage organically that by issuing floating or fixed debt than by swapping, although swapping is the other option. But we are heavily fixed. I think, if anything, we are tending to be slightly more floating now. Again, it's not, but that's a discussion we are having constantly with actually our shareholders. It's not entirely clear to us that rates will start rising quite as early as predicted, and in fact, we've seen, if anything, Matt Carney kind of saying very recently that despite the indicators he said that needed to be there for him to rise rates are going to be there, he might not rise rates after all. So, which again kind of seems to corroborate that view.
Okay, thank you. Looking at another question for our panel. How come secured bonds are not more common, since companies have plenty of securable assets? In the investment grade arena, do we see secure bonds that much?
Good question on secure bonds. They've been a bit more common in 2013, especially in the sterling market. We've seen Into issue twice, USAF Unite issue twice, the AA, Arqiva and Granger in the high yield bond market. I think there was a sense for a period of years in which secure bonds were maybe tarred with the same brush as structured bonds, too complex. So post-crisis, it's taken a while for them to come back, and for the value to be properly recognised by the market, because there is good value in much of that security. Now, the examples I've given relate mainly to the property sector, which is a natural for secured issuance, but I'm aware some sectors are not even allowed to grant security over physical assets. So we think about regulated UK utilities being the case in point there. So where we have seen secured deals this year, it's generally been to improve credit ratings by a notch, to secure better pricing. And we have seen exceptionally good investor take-up for these products.
Thank you. Well, it looks like a very straight, short question here. What has been the impact of funding for lending? So, to an extent, the bank market has been subsidised, has it? Is that increasing the popularity of the bank market?
Okay, this is not a...
Yes, no, absolutely. As Pedro's just said, HSBC is not part of funding for lending, so perhaps not the best place to comment. But
very true.
But from my own perspective, what I would say is it probably has given rise to some interesting distortions in the system. We're aware, as a third party, that funding for lending money has certainly gone to some very large and creditworthy UK corporates, as well as the smaller SMEs for whom it was originally targeted. So I think it has introduced some distortions actually to loan pricing in the loan market.
Because certainly the comments I've heard is that companies are looking at the capital markets, but in terms of just doing the cost-benefit analysis, to the extent they can find their way through to what might be subsidised bank funding, it's
correct. So
they just put them off a little bit, or deferred their plans for the capital market.
I would concur, Martin. Yeah.
I think it's important that funding for lending is quite short, so most of the subsidy is 2 years and extends maximum 3 years. So, but on those years, it has provided a massive subsidy rates.
But that will work its way out of the system soon. Okay. This one is perhaps dear to the heart of the ACT. It says, why don't we have a private placement market in the UK? So that. Yes, I'm happy to pick up on that a little bit myself.
Well, you start off.
Well, I've just mentioned that the ACT did look at this a year or so ago and put together a working group drawn from all sides of the industry, rating agencies, lawyers, advisors, what have you. And it was actually very frustrating because there seemed to be quite a demand on the issuer side, but from the investor perspective, somehow they had too many other things to invest in that it just wasn't worth the effort of gearing up to be able to assess and evaluate the sort of perhaps smaller issuers who might come to a private placement market. But we're optimistic that could be changing even now. I don't know whether you see anything from your side.
Well, I think you're right. This is the $64,000 question. So many forums, including your own, and attempts to kickstart this market. The best explanation I can give you for why it hasn't happened, primarily, particularly in the UK, investor focus on liquidity. That is what most of the main institutional investors in the UK continue to tell us, and that's right up to date because every time we're out in the market doing a sterling roadshow, we check with them, and with a very few exceptions, we get the same answer. Now, I'm sure the counter question will be, is there really any liquidity in the public sterling bond market anyway? And of course, we would acknowledge that once we have passed the initial primary period and the initial 3 months when you tend to see most trading, then there is limited trading, but there is some. And although a bid offer may be wide, I think it is very, very important to these investors to be able to hit that bid if they need to, if the constitution of their funds change, if their investor mandates change, and so on. So I think liquidity, this demand for liquidity is the biggest single thing. I think secondly, there's no history or legacy of the business in the UK in the way there is in the US, so no procedures, no infrastructure, no track record. In my speech, I talked a little bit about some of the regulatory limitations, and in the UK up until now, the investors on the insurance side have a 10% limit on the overall volume of unlisted instruments that they can hold. Now, given that limitation, investors are unlikely to utilise it for such low-yielding assets as implied investment-grade type private placements. They're going to go for mezzanine or other funkier forms of debt. I think some of these issues are not such a big issue for Euro investors. We have certainly done some very successful ultra-long-dated 20, 30-year Euro private placements, albeit off EMTN programs this year. So it doesn't feel to me as those liquidity issues are quite as high a priority for Euro investors, or perhaps it's just that there is such a bigger number of Euro investors that within their number we find some for whom it is not so important. So I would say those are the reasons, but I also think I said in my speech necessity could be the mother of invention here, and when it's really needed and when things like funding for lending disappear, I think that may help to be a catalyst.
I think your comments there, Dominic, very much accord with the sort of position that we saw when we were on that working group and looking into it. I guess things have changed a little bit. I'm aware that several housing associations have managed to do what, to all intents and purposes, are private placements, and good for them.
I think just following on that, because a lot of these housing associations have put with the emergency of basically firms or investment funds who take off the risk from pension funds, and they generally tend to be a lot more sophisticated and to be able to buy more and structure things. Do you think this is a trend which will evolve, so more and more pension funds will...
I would absolutely agree that we've certainly seen those involved in pension fund buyouts as having just a need for ultra-long sterling assets that can't be met by the supply we've seen, and we're looking at greatly reduced supply in the public sterling bond market this year. So you're right, from that source they've certainly been more flexible. I think another interesting area here that's related is Solvency II. I don't know, Mark, you want to say a few words on that? I'll just hand you that hot potato.
Thanks very much. No, I wasn't actually going to talk about that. What I was going to say, though, was that I think there may also be an impetus from the EC, and it sounds like a potentially longer-term sort of arrangement. But with the papers on long-term financing, it's obvious that they've picked up the baton and realised that a number of the measures that they've imposed have actually been counter to that growth and the diversification away from bank financing. And so I think we could see sort of the genesis of some new thinking, and I think that any of these original types of financing will be encouraged. And I wouldn't be at all surprised to see the EC producing papers to provide that impetus and stimulus in a number of the markets. Obviously, their focus might be more towards European bias than UK, but I still think there's an opportunity there.
Okay, well that's a hopeful note, because quite often one bit of regulation then is sort of destructive on another area of the market. And they can actually think in a joined-up way. That would be helpful. I think we've just got time for one more question. Pedro mentioned that the non-ring-fenced bank is likely to be, well, he says here, too risky. Does the panel have any thoughts on where the balance of risk is likely to sit between ring-fenced banks and non-ring-fenced banks?
Well, it's a very topical subject. It's coming up, and I think in the papers in the last couple of days there have been a number of comments about how that the few notch downgrades that were anticipated for non-ring-fenced bank might actually go the other way round. And at the moment, obviously, we're still sort of a bit unclear on where the land's actually going to lie with the legislation just going through. So it's another area I'd class as unclear, but worth watching. Yeah.
I mean, the current view of their likely ratings is just splitting the business in half and removing the perceived government support, which immediately leads to a downgrade of the bank, even before the considerations. So I don't think any big thinking has gone into the actual risk basis of both banks.
Indeed, I mean, particularly as the non-ring-fenced bank piece, would be arguably already predominantly financed by term debt because of the liquidity requirements. So the bifurcation, I think, is not perhaps quite so obvious.
Good. Well, thank you very much, Carol, for dealing with those questions. Thank you for those who've sent in questions, and I apologise if we didn't manage to get round to your question. As I mentioned at the start, we will be putting up a recording of this webinar on the ACT website. That should be up in 2 days' time, along with the presentations. And we'll be sending you a link to that for everyone who's actually registered on the day. I mentioned at the outset that this is the first of a new series of ACT webinars under the heading Navigating Regulatory Change. So perhaps we can pick up on some of the other regulatory matters that have been raised even today. This series has been supported by HSBC, so look out for the details of this, which will be coming out in a month or so's time. I've got a couple of other things to mention. That the ACT Annual Cash Management Conference will be on the 12th and 13th of February, so look out for that one. And of course the ACT Annual Conference, 14th to the 16th of May, up in Glasgow. So we have the new year just coming up. We've heard about the effect of regulatory change and how it might trigger us to relook at our corporate funding strategy. So perhaps this is a good opportunity to start planning for the new year and new period. I wish you all well in that planning, and thank you for joining us today.